Over the past decade, US stocks have grown to make up a significant share of global stock market indexes. We're talking as much as 71% in the MSCI World and 63% in the MSCI All World Index right now, based on current market valuations. For some investors, that's perfectly fine. They're comfortable with that level of exposure, especially given how dominant US companies have been in recent years. For others, it raises questions about concentration and geographic balance. And given recent tensions between Europe and US leadership, I've noticed that many European investors are starting to re-examine how much exposure they have to US stocks in their ETF portfolio. While I won't tell you what you should invest in or how to build your portfolio, today I want to take a closer look at how the share of US stocks changes depending on index design and portfolio structure. So if this was something you've been thinking about lately, this video should give you a good starting point to do more research and decide what makes sense for your situation. Before looking at any portfolio structures, it's worth clarifying what US exposure actually means. When investors read that US stocks have been dominating global indexes, it's easy to assume their performance is almost entirely dependent on the US economy, but it's more nuanced than that. Many of the largest US listed companies generate significant revenue outside the United States. Think about Apple, Microsoft, Amazon, Alphabet, or Nvidia. Yes, they're listed in the US and included in US indexes, but their customers, supply chains, and earnings are global. Apple sells iPhones worldwide. Microsoft sells software globally. Google's services, including YouTube, which you're on right now, are used everywhere. In fact, based on its latest annual filings, Apple generates around 57% of its revenue outside the US, and with Meta, that number is even higher, with 62% coming from other countries. So while these companies are domiciled in the US, their economic exposure is much broader. That doesn't mean geographic concentration doesn't matter. Currency risk, regulatory risk, and economic cycles are still tied to the US. But US exposure doesn't mean you're only exposed to whatever is going on in the United States. These are global companies. This explains why different investors can look at the same data and reach different conclusions. Some are comfortable with the US's current share in market cap weighted indexes, while others prefer to have their money allocated differently. Neither approach is right or wrong, but you should know what you own and why. Since many long-term investors in Europe start with ETFs covering a world or global index, let's start by looking at how exposure changes when additional indexes are combined. One common way regional exposure shifts is when a developed markets index excluding the US is combined with a world or global index. For example, US stocks currently account for roughly 71% of the MSCI World Index right now. The MSCI World ex-USA Index, on the other hand, covers developed markets outside the United States, with around 57% being in European stocks at the moment and the rest spread out across countries like Japan, Canada, and Australia. At today's market weights, a modest ex-USA component can move total US exposure closer to the 50% range. And parity between US and European stocks happens when the ex-US share is raised to roughly half of the portfolio. At that point, the US and Europe have a share of around 1/3 each, with the rest being allocated to other developed countries. The exact percentages will change over time as markets move, but the underlying mechanics remain the same. Another structural variation is combining a world index with a Europe-only index, like the Stoxx Europe 600 or FTSE Developed Europe. And while this increases exposure to European stocks more directly, it also reduces the allocation to all other developed markets outside Europe, such as Japan or Canada. So this approach offers more regional focus, but less balance globally. Again, this isn't about right or wrong, but about understanding the trade-offs. The same mechanics apply when starting from a global index that already includes emerging markets, like the FTSE All World, MSCI All World, or selective GBS Global. The FTSE All World index currently has about 61% exposure to US stocks, with roughly 10% allocated to emerging markets. Adding an MSCI World ex-USA index shifts that balance. The US exposure declines, the share of European stocks increases, and emerging markets become a slightly smaller share of the total. At current market weights, a small ex-US addition moves US exposure toward the 50% range, while a more even split like 60-40 moves it closer to 1/3. 1/3, while proportionally increasing Europe's share to a similar level and reducing emerging markets further. Once again, the exact percentages shift over time as markets move, but the mechanics stay consistent. There's also a practical limitation worth mentioning here. As European investors, we sadly don't have access to funds covering the FTSE All World ex-US or MSCI All Country World ex-US index right now. If those products existed, adjusting US exposure within a globally oriented portfolio would be much simpler. But since they don't, achieving a specific regional balance often requires combining 3 or more indexes instead, which is not necessarily a problem, but it does add complexity. By the way, you can find my favorite low-cost brokers in Europe linked down below, which is a great way to support me if you'd like to. The next approach flips the logic around and starts with the US index as one of the building blocks, before adding diversification from there. For example, this could involve combining a US index, a developed markets ex-US index, and optionally an emerging markets index. When combining an S&P 500 or MSCI USA with an MSCI World ex-USA index, it becomes a lot simpler to determine and manage the current share of US stocks in a portfolio at any given point in time. While some investors might want to reflect the current market cap weight of 60 to 70% depending on the index, others might feel more comfortable with something like 50% or 30% of their portfolio. Really, there is no right answer here. It all comes down to personal preference. By combining these two indexes, exposure parity between US and European stocks would currently be achieved by tilting more heavily towards the MSCI World ex-USA component. Stocks from emerging markets like India, Taiwan, China, and South Korea could also be added through an index like the MSCI Emerging Markets, with the trade-off being additional complexity and more ongoing management. Since the approximate weight in global indexes is in the 10% range right now, an overall share like that could be a possible consideration. For a somewhat even split between the US and Europe, the MSCI World ex-US index component would need to be roughly twice as large as the US index based on current valuations. Now here's something else that typically changes when lowering the share of US stocks. We usually see a shift in sector composition of the overall portfolio. Since many of the world's largest technology companies are US listed, reducing US exposure naturally lowers technology sector concentration, which is typically replaced by more exposure to sectors like financials, industrials, and consumer staples, as these currently carry a higher weight in other developed markets. The MSCI Emerging Markets Index is somewhat of an exception here, as it also has a relatively high exposure to technology at the moment. In most cases, dividend yields also tend to increase as a result of this shift, which could be relevant for investors that care about income or cash flow. When considering different portfolio structures, there are a few trade-offs that are worth understanding. First, deviating from market cap weighting means returns will differ from a standard global index. If US stocks outperform, portfolios with lower US exposure will lag behind. If US stocks underperform, the opposite will be true. There is no way to successfully predict either outcome. Second, holding multiple funds introduces ongoing management requirements. Different regions perform differently over time, which naturally causes allocations to shift. In many European countries, the most tax-efficient way to rebalance is through new contributions by directing fresh money to whichever position has fallen below its target weight. This avoids selling appreciated assets and triggering capital gains taxes unnecessarily. However, this may not be an option when there are no more contributions, for example, when a portfolio is already in the withdrawal stage. And generally speaking, the more complex the structure, the more important discipline becomes. Finally, and I think this is the most important point, there's the behavioral aspect. When holding multiple components, some parts of the portfolio will underperform for years at a time. From my own experience investing over the past 9 years, one thing I've noticed is that complexity creates more opportunities for second guessing and constant tinkering with allocations rather than better long-term results. At the end of the day, the best portfolio isn't the one that looks optimal on paper. It's the one you can actually stick to over decades. But different investors have different comfort levels when it comes to complexity, and that's perfectly fine. For my wife and me, we found that simply simplicity works well for our situation. We invest using a single accumulating ETF that follows market cap weighting and tracks a global index. When US stocks do well, they naturally represent a larger share of our portfolio. When they don't, that share declines automatically. We're comfortable with this approach because it removes ongoing decisions about regional allocation and rebalancing. And we also feel that this is likely to make withdrawing from our portfolio easier once we reach that stage. But that's just what works for us. I fully recognize that different investors have different preferences, a different risk tolerance, and different views on geographic diversification. What matters most isn't following any particular structure. It's understanding what you're doing and why, and choosing an approach you can maintain through different market environments. So if there's one takeaway from this video, it's this. US exposure in an ETF portfolio isn't something you either get right or get wrong. It's a result of how indexes are built, how markets have evolved over time, and how different regions have performed relative to each other. By understanding how those pieces fit together, you're in a much better position to judge whether your current setup actually matches your preferences or whether you're simply holding something by default. And just as importantly, you'll also understand the trade-offs that come with changing it. Lowering your share of US stocks doesn't automatically mean lower risk. Changing diversification across regions doesn't guarantee better returns. And more control almost always comes with more complexity. That's why I'm deliberately not telling you what allocation to use, because the right approach isn't about hitting a specific, perfectly appropriate percentage. It's about choosing a structure you can live with when markets move, narratives change, and one part of the world inevitably underperforms for longer than feels comfortable. If you want to explore this further, here are a few useful resources. Marketcaps.site is a great place to find the current weight of different regions in the MSCI World, All Country World, or even All Country World Investable Markets Index. You can find more details about the MSCI World ex-USA Index on the MSCI website, and you're usually able to find the most timely data for the FTSE All World Index composition on ETF providers' websites like Invesco or Vanguard. And of course, there's Just ETF to compare ETFs covering different indexes in detail. Now I'd love to know in the comments, do you prefer keeping things simple via a single global ETF, or do you prefer having more control over your regional exposure? You can find my favorite low-cost brokers in Europe linked down below, which is a great way to support me if you'd like to. And if you're interested in the practical side, including setting up recurring investments for ETFs and how to minimize fees when investing, make sure you watch this video next. As always, none of this was investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.